Ethan thought he'd finally beaten the banks. He moved his cash into a high-yield savings account paying 4.5%. He'd compared the rates. He knew a regular savings account was basically giving him nothing. Other people were earning around 0.45%, and he was getting 10 times more. Problem solved. At least that's what he thought. The bank was still earning more from his deposit than he was, and the thing it was doing with his cash, Ethan could have done a version of it himself and kept more of the return. But his coworker Natalie was in an even worse spot. She had $20,000 sitting in a traditional savings account. Over an entire year, her bank paid her $76 in interest. During that same year, the bank used her $20,000 to earn more than $1,200. Natalie got $76, the bank kept the rest. And she felt grateful whenever that tiny interest payment showed up. Natalie didn't realize how much she was giving away. Ethan thought he'd escaped that problem. Really, they were both stuck in it, just at different levels. Kyle Invests ran the numbers, and this is what banks would rather you never look at too closely. Natalie had done everything people call responsible. She saved 6 months of expenses and left the money in a savings account at a major national bank. Every month, she checked the balance and saw a little interest appear. A couple bucks here, a few more there. It wasn't impressive, but it made her feel like she was doing the right thing. Her account paid 0.38% APY, which is the current national average according to FDIC data. On $20,000, that works out to $76 per year, or about $6.33 a month. That's not even enough for a decent lunch. Natalie probably never stopped to wonder what happened to her $20,000 after she deposited it. Like most people, she may have pictured the money sitting safely in some bank vault, untouched and ready whenever she needed it. That isn't what happened. The second her deposit reached the bank, the money went to work. Just not for Natalie. It went to work for the bank, and the first thing the bank could do was lend it out. That's the basic business behind banking in America. Banks collect deposits, pay customers a tiny rate, then lend that money to other people at much higher rates. The gap between what a bank pays depositors and what it earns from lending is called the net interest margin. Right now, the average net interest margin for US banks is 3.39%, the highest level since 2019. Put that next to Natalie's account. Her bank paid her 0.38%. Using deposits like hers, it earned an average of 3.39% on loans. On $20,000, that leaves a spread of about $62 per year for the bank. Natalie received $76, and the bank collected another $62 from the same pile of money. And that's only the average. The numbers get much wider when you look at specific types of lending. Start with credit cards. The average credit card APR in the first quarter of 2026 is 21%. A bank can take deposits like Natalie's, pay 0.38%, then lend money to credit card customers at 21%. That's a spread of more than 20 percentage points. Even if only part of her $20,000 helped fund credit card balances, the profit from that portion could easily dwarf every dollar of interest the bank paid Natalie for the whole year. Her savings were safe from her point of view. From the bank's point of view, they were inventory. Credit cards are only one piece of it. New car loans are averaging around 7.5% right now. Mortgages are around 6.8%. Personal loans are closer to 12%. Deposits like Natalie's help fund every one of those products, and everyone earns the bank several times what she receives. Then there's the Treasury trade, which is even harder to ignore. Natalie's bank can take part of her deposit and buy short-term US Treasury bills. 3-month T-bills are currently yielding around 3.6%. So the bank uses Natalie's cash, earns 3.6%, and pays her 0.38%. That's a 3.22% spread on an investment Natalie could have purchased herself. The bank is standing between her and the US government and keeping more than 3% for doing it. Then it adds fees on top. American banks collected an estimated $12.1 billion in overdraft fees, NSF fees, ATM fees, maintenance charges, and other service fees in a single year. JP Morgan Chase alone collected more than $1 billion in overdraft fees in 2024. Wells Fargo collected nearly as much. The same customers supplying the money for the bank's lending business are also getting charged to use the system. And the bank has more ways to make money from Natalie than just loans and account fees. Every time she uses her debit card, the bank earns interchange revenue from the merchant. When a transaction stays pending for a day or two, The bank may benefit from the float before the money fully clears. Her spending patterns also create anonymized data that banks can package and share with marketing partners. Each one is another stream of revenue tied to the same customer whose savings are already funding the bank's operations. Once you put the whole picture together, Natalie's bank wasn't simply holding her money, it was renting it from her. The bank paid $76 a year for permission to use her $20,000 in different ways, while Natalie looked at the interest deposit and thought the account was earning money for her. Now we need to talk about Ethan, because he represents the person hearing all of this and thinking, yeah, I know regular savings accounts are terrible. That's why I switched to a high yield account. And to be fair, Ethan did make a better choice than Natalie. His account paid 4.5% instead of 0.38%. On $20,000, he earned about $900 a year compared with her $76. That's a major improvement. Ethan researched his options, moved the money, and started earning more than 10 times what the average saver was getting. So where's the issue? The first problem is that the 4.5% in the advertisement may not be the rate he actually earns on all his money. A lot of high-yield savings accounts advertise rates using the words up to. Those two words matter. Some banks have tiered structures where the highest rate applies only to the first $500 or $1,000. Everything above that amount earns less. Other accounts offer the advertised rate for the first 90 days and then lower it after the promotional period ends. Ethan saw 4.5% in large print, but his effective rate could be lower. The second problem is taxes. Savings account interest is taxed as ordinary income, whether it comes from a traditional account or a high yield account. That means federal income tax and, depending on where Ethan lives, state and local income tax too. If he's in the 22% federal bracket and lives in the state charging 5% income tax, more than a quarter of his interest disappears to taxes. His $900 of advertised annual interest drops to roughly $650 that he actually keeps. Then there's the biggest problem. What is Ethan's high-yield bank doing with his money to generate enough income to pay him 4.5%? Mostly the same things Natalie's bank was doing. It lends deposits to borrowers, it buys Treasury securities, it runs the same basic profit model. A high-yield account simply gives the depositor a larger share of what the bank earns. That's better, but it's still only a share. The bank remains in the middle and keeps its cut. Ethan never asked the obvious follow-up. If the bank is using customer deposits to buy Treasury bills and earn around 3.6%, why can't he buy Treasury bills himself? So Kyle Invests compared the numbers using the same $20,000 over the same 12-month period. In the first scenario, Natalie leaves the money in her traditional savings account earning 0.38% APY. She receives $76 in gross interest. After federal and state income taxes, she keeps roughly $55. She did what people told her to do. She saved 6 months of expenses, avoided spending it, and kept it somewhere considered safe. After a full year, her reward for all of that was about $55 of spendable interest. In the second scenario, Ethan keeps the same $20,000 in his high-yield savings account at 4.5%. His gross interest for the year is $900. With a combined federal and state tax rate of 27%, he keeps about $657. That's a huge jump from Natalie's result, no question. But every dollar of that interest is still exposed to both federal and state income taxes. The third scenario uses short-term Treasury bills through an ETF like SGOV. As of April 2026, SGOV's 12-month trailing yield is 3.95%, while its 30-day SEC yield is 3.55%. On $20,000, the trailing yield produces approximately $790 in gross income over a year. Using the current 30-day rate, it would be closer to $710. But Treasury income has one important tax advantage. Interest from U.S. Treasury securities is exempt from state and local income taxes under federal law. Ethan owes federal and state tax on his $900. The SGOV investor owes only federal tax on the $790. After taxes, that investor keeps roughly $616 at the trailing yield without paying any state or local income tax. At first glance, Ethan's account still appears to win by a small amount, but that isn't the full comparison. In this exact example, yes, 4.5% is higher than 3.95%, so Ethan's high yield account produces slightly more after-tax income. But that 4.5% is a bank rate that can change whenever the bank decides to change it. Ethan might wake up next month, open an email, and learn that his account now pays 3.5%. SGOV's yield also changes, but it follows the actual rates produced by US Treasury bill auctions. The process is transparent and market-driven. There isn't a temporary headline rate designed to get someone through the door. Ethan's savings interest is also subject to state income tax, while income from Treasury securities is not. In a high-tax state such as California or New York, that exemption can be enough to erase the difference between the two options. And with a high-yield account, the bank is still sitting in the middle. SGOV removes that bank from the transaction. The investor is effectively lending money to the US government through short-term Treasury bills and keeping the yield after a 0.09% annual fund fee. This doesn't mean SGOV will beat every high-yield account at every moment. Rates move, taxes differ, and people need different levels of access to their cash. The real point is that Ethan never knew this option was available. He treated the high-yield savings account like the finish line, when it was really just a better spot inside the same banking system. So what should someone actually do? First, keep the checking account. There's no reason to shut it down. You still need a place for regular income and spending. Rent, utility bills, groceries, subscriptions, and everything else moving in and out during the month can stay there. This isn't about making everyday money harder to use. It's about deciding where cash should sit when it isn't being used. Second, figure out how much idle cash you have. That could include an emergency fund, general savings, money waiting to be invested, or cash being saved for a house down payment or another major purchase. It's money you don't plan to spend today, but you also don't want locked away for years. For a lot of people, that cash sits in a traditional savings account, earning almost nothing, while the bank uses it to earn 10, 20, or even 50 times more. Once you identify that amount, you can compare places that give you more of the actual short-term return. One option is a Treasury bill ETF such as SGOV. You can purchase it inside a normal brokerage account through Robinhood, Schwab, Fidelity, Weibull, or whatever platform you already use. It trades like a stock, but the fund itself invests in US Treasury bills that mature in 3 months or less. Each month, the fund pays a distribution, which is the interest income generated by those securities. The yield is currently around 3.55% to 3.95%, depending on whether you're looking at the 30-day SEC yield or the trailing 12-month yield. When you need the cash, you sell the ETF during market hours. Its share price stays near $100 because the portfolio holds very short-term government debt and is built to remain stable. The annual expense ratio is 0.09%. On a $20,000 position, that comes to about $18 per year. And because the underlying income comes from US Treasury securities, the qualifying portion of the distributions is exempt from state and local income taxes. You get simple access through a brokerage without leaving all the short-term yield with a bank. A second option is TreasuryDirect.gov, the US government's own website for buying Treasury securities. This is the most direct version of the strategy. There's no bank in the middle, no brokerage fund, and no ETF expense ratio. You create an account, connect your bank, and submit an order for Treasury bills at auction. The bills are purchased at a discount. When they mature, you receive their full value, and the difference is your interest. The trade-off is flexibility. Treasury Direct is less liquid and less convenient than an ETF. Depending on what you buy, you're committing the money to a maturity ranging from 4 weeks to 52 weeks. You can set the bills to reinvest when they mature, or you can have the proceeds returned to your linked bank account. If you know you won't need the money immediately, this is the cleanest way to remove the financial middleman. You're not depositing money with a bank that later buys government debt and passes a small piece of the return back to you. You're buying that government debt yourself. No promotional savings rate. No bank deciding how much of the yield it wants to share. The third option is a money market fund. Brokerages such as Fidelity, Schwab, and Vanguard offer these funds as a place to hold cash inside an investment account. They invest in short-term government securities and other high-quality short-term debt. Unlike buying an individual treasury bill and waiting for it to mature, a money market fund gives you daily liquidity. You can generally move the money out whenever you need it. Current yields are competitive with many high-yield savings accounts, although they change as short-term interest rates move. The exact tax treatment depends on what the fund owns. A general money market fund may hold government securities, bank obligations, and corporate debt, so not all of its income will necessarily qualify for a state tax exemption. But if you choose a Treasury-only money market fund, the portion of income generated by qualifying U.S. Treasury securities can receive the same state and local tax advantage as SGOV. The main idea is simple. There are ways to earn the current short-term market rate without leaving your money in a low-paying savings account and letting the bank keep most of the difference. This is usually where people bring up FDIC insurance. A savings account at an insured bank is generally covered for up to $250,000 per depositor per insured bank. For each account ownership category, if that bank fails, the federal government stands behind the insured deposit. That's real protection, and it shouldn't be dismissed. But look at what you're comparing it with. Treasury bills are debt issued by the same U.S. federal government that backs the FDIC system. When you buy a Treasury bill, you're lending directly to the federal government instead of placing your money at a bank with a federal guarantee behind it. Treasury securities aren't FDIC insured because they aren't bank deposits. They're backed by the full faith and credit of the United States. The source of the protection is still the federal government, but the structure is different. With the savings account, the government protects your deposit if the bank fails. With the Treasury bill, the government itself owes you the money. So moving cash from a savings account into Treasury securities isn't the same as abandoning safety to chase some risky return. You're changing how that government backing reaches you. The next objection is access. People hear Treasury bills or brokerage account and worry their emergency fund will be trapped when they need it most. That concern is fair. Emergency money has to be available. This is why the checking account stays funded for normal expenses and immediate needs. With an ETF such as SGOV, you can sell your shares during market hours, but the cash may take 1 or 2 business days to settle and become available for withdrawal. That isn't the same as opening a banking app and transferring savings instantly. Still, it helps to be realistic about the kind of emergency you're planning for. When was the last time you needed all $20,000 in physical cash within 60 seconds? Most large emergency expenses don't work that way. A medical bill, major home repair, insurance deductible, or unexpected travel cost can usually be handled while a sale settles. You might keep a smaller immediate cushion in checking or savings and place the rest somewhere earning more. The right split depends on your bills, job stability, credit access, and comfort level. It doesn't have to be all or nothing. The extra access delay has a cost, but so does leaving the full balance in an account earning 0.38%. On $20,000, the difference can add up to hundreds of dollars every year while you wait for an emergency that may never require the entire balance at once. That doesn't mean everyone should move every dollar into SGOV tomorrow. It means access should be planned instead of used as an automatic reason to accept almost no return. Natalie was responsible. She built her savings, left the money at a major bank, and checked the account regularly. By the rules she'd been taught, she was doing everything correctly. Ethan went further. He compared rates and moved his cash into a high-yield account paying 10 times more. He was clearly ahead of Natalie, and the move put hundreds of extra dollars in his pocket. But both of them stopped their research at the account rate. Neither one asked what happened after the bank received the deposit. That question changes the whole comparison. The bank wasn't letting their cash sit untouched. It was lending the money, buying short-term government debt, collecting fees, and building several sources of revenue around the same deposits. That brings us back to the question neither Natalie nor Ethan asked. What is the bank actually doing with my money, and can I do some of it myself? In many cases, the answer is yes. The bank accepts your deposit, pays you a rate it controls, and puts the money into assets that produce a higher return. Some of it may support auto loans near 7.5%, mortgages around 6.8%, personal loans around 12%, or credit card balances near 21%. Another portion may go into short-term Treasury bills yielding around 3.6%. The exact mix differs from bank to bank, but the basic model stays the same. The bank earns more from the money than it pays the customer, then keeps the difference. That isn't some secret violation of the rules. It's how banking works. The mistake is assuming that the rate your bank offers is automatically the best return available for safe short-term cash. Natalie accepted 0.38%. because the account felt normal. Ethan found 4.5% and assumed he had reached the best possible option. Once you understand the assets behind those rates, You can compare the bank's offer with what's available directly through Treasury bills, Treasury ETFs, and money market funds. The smartest move isn't automatically closing every savings account. It's matching each part of your cash to what you need it to do. Money for today's bills needs immediate access, so checking makes sense. A smaller emergency cushion may also belong in a bank account. If instant transfers help you sleep better, cash you probably won't need for several days or months can be compared against SGOV, TreasuryDirect, or a money market fund. Look at the current yield, how quickly you can access the money, the expense ratio, and the tax treatment in your state. Also remember that none of these rates are permanent. High-yield savings accounts can lower their APY. Treasury yields move with the market. Money market fund yields change too. This isn't a decision you make once and then ignore forever, but you also don't need to move money every time one rate changes by a few hundredths of a percent. The goal is to understand the choices and avoid leaving a large balance at 0.38%, simply because that's where it has always been. Even moving from Natalie's result to Ethan's result turned $76 of gross annual interest into $900. Where your cash sits matters. For the same $20,000, Natalie kept about $55 after taxes in the traditional account. Ethan kept roughly $657 from the high-yield account under the combined 27% tax assumption. The SGOV investor kept about $616 using the 3.95% trailing yield and paid no state or local income tax on qualifying Treasury income. Those results are close enough that the best choice can depend on the current rates and where you live. In a state with no income tax, Ethan's 4.5% account may look more attractive. In a high-tax state, the Treasury exemption becomes more valuable. If you need bank-style access at every hour, a savings account may be worth keeping. If 1 or 2 business days is acceptable, an ETF may work. If you can wait until a known maturity date, buying bills through TreasuryDirect removes the fund fee entirely. And if you want daily liquidity inside a brokerage, a money market fund may be the easier fit. There isn't one answer for every dollar and every person, but there is a better process. Compare what you keep after fees and taxes, then consider access and stability. Don't make the decision using the advertised rate alone. Natalie wasn't careless. She saved 6 months of expenses and protected herself from unexpected bills. Ethan wasn't careless either. He noticed that regular savings rates were terrible and took the time to find something better. Both made reasonable decisions with the information they had. They just stopped one question too early. A high-yield savings account can be a useful option, and it may be the right one when its after-tax yield and access fit your needs. It just isn't automatically the final answer. Your bank is using idle deposits every day. You should at least know what return those deposits are helping it earn and what alternatives you can reach yourself. Start by finding the cash that isn't needed for regular spending. Keep enough available for immediate expenses. Then compare the after-tax return from your savings account with short-term Treasury bills, an ETF like SGOV, and suitable money market funds. A few minutes of comparison could change the income from that cash by hundreds of dollars a year. If this showed you something new about what happens after you deposit your money, subscribe to Kyle Invests and turn on notifications. We break down the numbers hiding behind everyday financial decisions. And the next one is worth seeing.